A company reports 1,000 crore revenue. Everyone celebrates. But at the end of the year, the actual profit is just 40 crore. So where did the rest of the money go? To understand this, you need to follow the entire profit journey, from gross profit to operating profit, and finally to net profit. Quick context: gross profit margin. Let's start with a quick reminder. Gross profit margin answers one simple question. After making the product, how much money is left? The formula for gross profit margin is revenue minus cost of goods sold, divide by revenue, multiply by 100. Cost of goods sold includes raw materials, manufacturing costs, direct labor. If a company earns $100 in revenue and spends $60 to make the product, $40 is left as gross profit. This tells us about pricing power, cost control, and strength of the business model. But this is only the first layer of profitability. Operating margin context. After gross profit, the company is still not done spending. It has to pay for salaries, office rent, marketing, administration, research and development. These are called operating expenses. When we subtract these from gross profit, we get operating profit. The formula for operating profit margin is operating profit, divide by revenue, multiply by 100. Let's continue the same example. Revenue is $100, gross profit is $40, operating expenses are $20. Operating profit becomes $20. That means the operating profit margin is 20%. This margin shows how efficiently the business is actually managed. What operating margin tells you? Operating margin reflects management discipline, cost control, and scalability of the business. Two companies can have the same gross margin, but very different operating margins. The one with better operating margins is usually the better run business. Operating margin warning signs. Be careful when revenue is growing fast, but operating margin is falling every year. This often means the company is spending aggressively just to show growth. In the long run, this destroys shareholder value. Net profit margin. Now we reach the final number everyone talks about, net profit. After operating profit, the company still pays interest on loans, taxes, and one-time or exceptional costs. What remains is the net profit. The formula for net profit margin is net profit, divide by revenue, multiply by 100. Final step of the example. Operating profit is $20, interest and taxes together are $10, net profit becomes $10. So, from $100 of revenue, $40 is gross profit, $20 is operating profit, $10 is net profit. This is the complete profit journey. What net profit margin really shows? Net margin reflects debt burden, interest costs, tax efficiency, and overall financial discipline. A company can have strong operating margins, but weak net margins if debt is high. That's why net margin is the final filter, not the first. How smart investors use all three together. Good investors never look at one margin in isolation. They ask, are gross margins stable over time? Are operating margins improving? Do net margins hold up during bad years? Together, these three margins reveal business quality, management efficiency, and financial strength. This is how professionals analyze businesses. Final takeaway. Think of profit margins as layers. Gross margin shows product strength, operating margin shows management efficiency, net margin shows financial discipline. If even one layer is weak, the business becomes vulnerable. Understanding these margins is the foundation of long-term investing. If you want to learn investing, business analysis, and fundamentals in a clear and practical way, follow Fineryx.